I am ready. Good morning, everyone. Thank you for joining for another fun-filled edition of the Real Estate Backstory. My name is Alan Richardson. I'm the managing broker here at Maximum Realty and Realtor Partners.
My name is Ming Richardson, the compliance broker from Maximum One Realty and Realtor Partners.
We're sure glad that you're joining us today. So we have a lot of really cool stuff to go over with you guys this week. So today's the 14th, and summer's here upon us, but we got a lot of great things going on. Yeah, it is hot. So we're going to start off with, the CE we have a ton of CE continuing education coming up this week. So first of all, today at 9:30, I'm going to be teaching the Ultimate Buyer System today. That's live and on Zoom both. It's live in the Conyers office and on Zoom. So on Tuesday, we have Contracts, Offer, and Acceptance, which is a virtual contract class. That starts at 10 a.m. Then on Wednesday, you guys get stuck with me for twice this week. So I'm teaching on Wednesday again, where I'm teaching the Ultimate Listing System, and that is going to be live in Conyers and also virtual. Thursday, we have Understanding Values in This Crazy Market, and isn't that a blessing right there? If you can understand the values we have going on in this market, then you're pretty much a guru right now. So, and then Friday, again, we're teaching live in our Conyers office and our virtual, show me the money and get me to closing. And so, that's going to be, that's all the CE that we have kind of going on for this week. So we hope that you guys will kind of jump in with us. We look forward to that. So we want to start off by talking about cash offers. And so cash offers are, we're seeing just a massive influx of the number of cash offers. So, but first of all, let's explain this a little bit. We want to talk to you about some different programs and things like that. So first of all, an all cash offer doesn't mean that we got buyers showing up with a suitcase full of cash. They're not like, here we are, da, da, da. But it does mean that they're going to purchase the home without necessarily taking out a traditional mortgage, or at least not a mortgage right up front. Now, this seems pretty impossible for folks struggling just to get a 5% down payment, especially, and even for those who are trying to get a 20% down payment to get rid of MI, that kind of stuff. It seems really, really challenging. But the reality of it is in April, 25% of all home sales were all cash deals, 1 out of 4.
So that means that's 15% increase from last year on cash offers. So we're kind of pondering, okay, where all of a sudden this cash offer is coming from? There's a couple programs out there, just so you know. There's Divvy, Ribbon Homes, Home Partners of America. They are representing the actual end user. So, 9 out of 10 is not always the investors that's buying it. So it's actually these third-party servicer that is basically helping the buyer temporarily to get a cash offer so they can win the bid, because a lot of sellers right now are not willing to take the risk of the appraisal value due to the crazy increase of value that we have had in the last 3-4 months.
And you can't blame them. I mean, if you're, we had one offer recently where we had a 280 offer, but we had a 277 all cash offer. And the 280 was a VA offer. And
well, it's actually conventional.
Oh, conventional.
Yeah, with 20% down. So it was a very strong buyer.
Was, but our sellers took the 277 all cash because there was no financing contingency. They were kind of
no appraisal.
They didn't have to worry about it.
Now the kicker on this is that they still have their due diligence period. And during that period, let me tell you, what they're doing is to inspect the house. Okay. And 2, they will have what we call desktop BPO, broker pricing opinion. Someone come in to evaluate the house and make sure whatever the buyer bid on for the property is going to go for the loan. And now with Ribbon program which is very unique. I actually talked to the consultant last week, and basically, let's say for example, if you make an offer at 250. If the appraisal value, when they do desktop BPOs at 245, they may go with it, or they may try to renegotiate. So what happened is that if the BPO does come back $5,000 below the purchase property, they will actually make up the difference, which is something unheard of. But at the same time, of course, you're not going to get that money for free neither.
Right.
So
there's cost.
It is a 1% if the buyer finished the loan before Ribbon has to buy it. or it's a 2.4% if Ribbon has to buy the property and turn right around and sell it to the buyer.
So just to clarify, so if, on for most of these programs and Ribbon and several of these, if you'll go ahead and have your buyer financing in place, and you have that financing in place before the home closes, then they only charge a 1% fee.
Out $250,000, there's a $2,500 fee. And right now we all are overbidding anywhere from 10 to 25, 30, depending on the value of homes above what the house is listed. When we list our property, we were right on the top of the fair market value. So it was a pleasant surprise to get additional, money, $22,000 on top.
So, like what we wanted to point out is that there is some options for people having financing, and that we are seeing more and more of these deals coming through.
Especially VA and FHA, because no seller, and unfortunately for our vets, I mean, it doesn't sound fair or anything like that, but if you were the seller, you want to take the best sure deal versus something that can be held over by Tidewater and VA.
Yeah, that's the real big challenge here, is that we really want to see VA, we really want to see FHA. FHA, those are traditionally a lot of our first time buyers. VA, these are our veterans, but largely because of appraisal issues and that kind of stuff, there has to be some other options. And so we're just trying to be creative out there, and we're seeing a lot of other agents being very creative, and so we want to make sure that everyone's kind of playing off the same page of
it's so sad because at one point we were doing escalation calls, and next thing we were doing appraisal guarantee, and now we have to have cash in order to win the bid. I mean, but that's what the market is demanding at this point.
It is going to be tailoring down here a little bit. We will see that kind of moving over just a little bit more here really soon. So. And we just had Beth jump on here with us. So, hey, Beth, how are you doing?
Good morning, Beth. Beth is.
Good morning. I'm sorry. I was having Zoom issues this morning. But
no worries. No worries.
I'm good. How are y'all?
Very good. Thank you for joining us this morning.
Absolutely.
So, we are blessed. So we love our relationship with Lunar Lark and Hunter, and so we really appreciate you guys being such a big supporter of Maximum One. You guys supported we had an agent appreciation this past weekend. You guys did our jumpy house, which we really appreciated.
Enjoyed it.
And you're even sponsoring a CE class today. So thank you very much for that. How are things in the closing worlds going?
It's just busy as ever. I feel like I say that every time, but it hasn't slowed down. I'm seeing the rates go up just a little bit, but it hasn't slowed down from our perspective. I think actually June's going to be a huge month. We've already just blown it out of the park with the number of closings we've done in the first 2 weeks.
Wow, that's great news, kind of thing.
Yeah.
And so any issues or concerns that you're seeing out there in the marketplace right now on the closing side? Anything we need to be leery of, watching out for?
Not that, you guys have talked about the escalation clause, and what you guys were just talking about. For sure, with escalation clauses, appraisals, VA is definitely discriminated against sometimes, but it's just the nature of how it is.
Well, I mean, that's the thing I hate about the VA, and the challenge with the VA is, for what we see, is that the VA appraisals, we end up with Tidewater more than we like to admit.
Right.
So, but are you seeing a lot more cash offers come through on your end as well?
Yeah, we have a lot of cash files coming through. I think those tend to be the ones that win the bids.
Well, a year ago it was 1 out of 10. It was 10% were cash offers. Now it's 1 out of 4. So it's definitely a different environment, for cash offers right now. We're seeing folks having to be really creative with it.
Yeah, and it's a lot of investment companies too that are coming in to do rentals and taking those houses away from people that want to buy homes and not rent.
Absolutely.
Well, yeah, we saw where BlackRock has been buying up a lot of properties that way too, and now we're even starting to see where neighborhoods where a builder was building an entire neighborhood, now they're building it, renting it, and then selling it off, kind of thing.
Yeah.
So, and that's inventory that we really need for our buyers,
especially kind of thing. But they know the investor will come and buy it for cash because of low inventory right now. So,
Mhm.
really is not a competition for them.
Yeah, it's a shame.
Oh yeah, it is in there. So any other issues that we need to be watching out for right now?
I don't think so. You guys had mentioned last time wanting to know about changes to the 1031s and capital gains. I don't know. I can't answer like a whole lot of detailed questions, but I can tell you guys what their Congress is currently mulling around and talking about changing.
It is the overview.
So one of the things they're talking about changing is limiting the proceeds on 1031s to $500,000.
Oh, wow.
Right now, if you do a 1031 exchange, you can, exchange property, defer your capital gains tax on that sale by investing it immediately into another property and keep deferring until you're ready to cash out. Now they're talking about limiting that and putting a cap on it at $500,000.
Is that $500,000 per transaction or for the lifetime of 1031?
That's a good question. I think it's per the transaction, but then that keeps rolling over. But again, this is all this is part of a Biden's proposal, and nothing's been official. So it could all change. That could go away, or it could be, those numbers could change a lot. But that was in the initial proposal. And then the other thing that they were talking about changing is the tax rates for capital gains for people making over $1 million. So this isn't going to affect most standard transactions, but if somebody does have an income of over $1 million, or even just for that 1 year because they're selling a high income house, capital gains could jump from the 20% rate to 37 to 39%.
Almost double.
So, yeah. And so they're talking about doing that too, which would be, it wouldn't affect most of our standard closings around here,
Right.
but it would affect a few here and there.
Well, it really going to affect the investor market. I know that for most of the 1031s that we see, they're well over $500,000.
Right. And I mean, yeah, and a lot of that the 1031 changes, that could affect a lot of normal 1031 closings. The capital gains on the $1 million over, that's not going to affect as many, but a lot of 1031s are just normal investors that that's how they make their income, and that $500,000 is not a terribly high threshold.
Well, the only thing that we're seeing that, I don't think we have as much of it in our area, but if you're up in the Northeast or you're out in California, $1 million home is just, it's a 3 ranch in a lot of places in California. So, so if you sell your home and you don't, and you've paid it off kind of thing, that's going to hit you really, really hard. Kind of thing. So if you're in New York, California, I think that will have a much bigger financial impact than necessarily. We just don't have it as appreciating of a market as they do, kind of thing. Right. Very good. All right. Well, thank you very much. Do you have anything else that you want to shout out to us or anything?
Well, we just really appreciate y'all's business. Thank y'all so much. We get a lot of contracts through the Max One VIP email address. And we love working with all of your agents. So thank y'all so much for that business. We really appreciate all of your support.
Awesome. Absolutely. And we appreciate yours.
Yeah, we're way. So, awesome. All right. Well, we're going to keep running. If you have anything you want to chime in, please chime in. But we're going to keep rolling here. So
sounds good. Thank y'all.
Thanks,
Beth. All right. Well, we are going to we're going to keep rolling here. So we kind of want to kind of run through some of our financial numbers that we're seeing out there right now and kind of what's going on. First thing is that initial jobless claims dropped again down to 376. That's the lowest number that we've had. So we continue to see improvements in the job market. So that's really, really great to see. On the kind of the negative side of what we're seeing is that consumer inflation is really starting to inch up. It's up 5%. And so, we haven't seen inflation rise at these rates for a very, very long time. It's been about 3 decades kind of thing. Overall, the core inflation rate rose about 3.8%, and that's the sharpest increase in 30 years. And a lot of it's where we're coming back out. We still see a lot of shortages. We're going to talk about paint today because paint is our new shortage issue that we're looking at. So, but as of right now, that inflation has not impacted mortgage rates. And mortgage rates are still at a 2.9, 2.96, 2.99, right in that range. So that's looking really good. I do have a little bit of a concern because guess what the Fed does next week? The Fed meets next week, and they're going to be looking at these interest rates again, kind of thing, and how that can impact, kind of what we see going forward. Because the Fed changes monetary policy, that's going
to change our interest rate.
And so I'm going to be watching the Fed's meeting next week with bated breath. Now, for our sellers, we had $821 billion in homeowner equity gains in the first quarter of this year, kind of thing. And so, CoreLogic also released a homeowner equity report, kind of thing, which shows that the average, collectively, $33,400 per borrower in equity growth since the first quarter of 2020. So for those folks, basically, if you bought a house a year ago, your house is about 30 grand more than you built $30,000 in equity.
And that's average. And I've seen some markets where it's about almost $100,000 from last year, where homes they were having a hard time selling last year this time at 325 is now worth 400, 412 ish.
Yeah. Now, one of the side effects of this, we keep hearing people that, like the foreclosure moratoriums are coming to an end, the eviction moratoriums are coming to an end. But if you look at this, from the fourth quarter of 2020 to the first quarter of 2021, total number of mortgage homes in negative equity decreased by 7%. There's only 1.4 million total, or only 2.5% of all mortgages in the U.S. are in negative equity,
right,
in the entire U.S. And so that's becoming a much smaller number, kind of thing. And so at the same time, annually, kind of thing, 1.8 million homes, or 3.4% of all mortgage properties, were in negative equity. So this is continuing to remove that negative equity. Means that even if folks do need to sell, we're not going to be looking at this REO foreclosure kind of thing. We're going to be seeing folks who are actually cashing out.
The thing too is that it's about education. So if you educate your client about what the market's doing, a lot of them still think, oh no, we're back to the back in 2008, 2009, during that era. That's not the case, y'all. You need to educate your client, say you may have more equity in your home than you realize because what the market's doing right now.
And so at the same time, 8 out of 10 homes sold at or above list price. Now, we all know that this is not, if you're in the market, kind of what's going on with that. But I think it's important that we communicate with our buyers. We need to let our buyers know exactly what they're facing in buying homes today. 8 out of 10 homes sold at or above list price, 80%. So the days of, let's try it for 5,000 less, or I just don't see that house selling for this price. Unfortunately, it is that's the market that we're in right now. Now we are seeing signs of that shifting. And so there is going to be some flattening of pricing and that kind of stuff coming up, especially if the interest rates go up.
And that's because the seller is comparing their home to the recent sale. And some of the recent sale may be inflated because, people are desperate for homes.
Yep.
So but at some point, that pricing is going to flat out at some point.
Yep. So anyway, just to make sure that we are communicating with our buyers, kind of the environment where we are buying in right now, what we find is that if we will spend some time educating and communicating with our buyers, they're much more prepared for what's going on in the market then. We talked about equity. And so this shows that equity number by state. And so you can see here in Georgia, we saw an average equity of around 24,000. Over the past year. So the numbers we gave you before were nationally. This is our average equity per state. So here in Georgia, it's around $25,000 per house if you owned a house a year ago. We're not looking at this equity going down. We're looking at it continuing to move up. Maybe not at the same rate of growth, but when folks are saying, well, I'm just going to wait. Well, if you'd said that a year ago,
Guess what? Cost you
it would have cost you 25
$24,000.
grand kind
Yeah.
of thing.
And if you thought California is expensive a while back, they jumped up 70 grand
Yeah.
over last year. So it's even more expensive.
Yep. So, we are seeing that price growth is beginning to slow finally, but still everything is selling at record speed. And so,
And that's because low inventory.
it is. Everything's being driven by low inventory and high demand, but we are starting to come back around full circle. This is when the housing market started to erupt last year. So we're going to start seeing much more modest increases over prior year, that kind of stuff. Nationally, the typical home only spent 39 days on the market, 32 days less than a year ago, kind of thing. So overall, our national inventory, our active listings declined by half, 50.9% over last year. So we are seeing, continue, we're probably going to run hot and heavy all the way through summer, and hopefully we'll see some cooling off, in the fall.
I don't know about that.
But, at the same time, there are some indicators here that there is some relief coming, kind of thing. Asking prices have leveled off as pending sales, which were rising, at this time, posted a 3% decline for the first time. We're still selling record prices, still selling record speeds. And so, we're going to share some of these numbers with you here, kind of thing. And so, first of all, our high-end homes are outperforming any other. So you can see that high end is up about 26%. Affordable housing, what they call affordable, which is our starter homes, that kind of thing, that's about 17% up. And mid-priced is actually the most, in that middle price range, somewhere in that $300 to $450 range, kind of thing.
14%.
Yeah, it's almost 15%. Overall, you can see that everywhere homes are flying off the market. This shows, our days on market compared to the last 8 years. And you can see that this is nothing like we've ever seen before. These are our normal historical trends. And you can see, whereas, we've got this wave kind of thing going on. We're not seeing that this year, kind of thing. And so we are hoping to see that fall starts ticking up here a little bit more once we get around to that point. Overall, for our, for the 3 months ending April, kind of thing, here in Atlanta, homes sold year over year is, up 6%, mid prices up 4%, high ends up 21%. So here, our affordable homes actually have seen the least amount of increase, kind of thing. And then you can also see the median prices in there. So our median in the affordable price range here in the Atlanta market is right at 180. Our median for mid prices are at 270, and then about 4.25 is for our higher end here.
If you look at median days on market year to date, those are all in negative. So as soon as the inventory comes up, it gets gobbled up.
Yeah, I mean, right now, the fact that high end homes are selling in 16 days on market, mid price 12 days on market, and affordable 11 days on market, there is not much change. We're seeing that the demand for all homes, high end, I mean, there for a while, we were seeing where the high end homes were running a little bit higher days on market still. The high end is now rocking just like everything else is at the moment. So, that continues to be something that we're seeing. Now, we also pulled some data from realtor.com and wanted to share that with you. And so this is our active listing count. And so you can see what our historical national trends have been. And so you can see in May, where normally our active listing counts start inching up. And you can start this okay, now we are down in the bottom left-hand corner, okay, we're the yellow.
What a yellow.
And so you can see where our total number of active listings is way below. But and it's hard to see, but we are starting to see a slight uptick. That is really good news. The fact that we are starting to see more active listings coming into the market in which is actually our busiest time of the year. Normally, our summer buying season is when we sell more homes here in Georgia than any time going through this time period here. Now, at the same time, this is how we stand on newly listed homes. So, and we can see that we are seeing a positive growth trend on the number of newly listed homes. So we're up 5.4%, and we need that. We need more listings. Like I said, this one shows it a lot more clear, but you can see where the past years are. You can also see what happened this time last year. And this shows it really, really clearly. Remember when we shut down? Boom, all of a sudden, everything went.
April was a tough month for everybody.
No, and so you can see where we are just about to meet up, another month or two, and we're going to be following that green line here pretty consistently, I feel like. Days on market. This one's kind of ugly, and we knew this already. I mean, if you're in the market, in the marketplace, that our days on the market, the demand for houses is, this is our lowest in
history.
Yeah, pretty much. And then at the same time, that low inventory, that's what's causing this median list price growth, and that's what we're really seeing right now. You can see that it is pretty staggering. Even last year, when we had the pandemic, it went flat for a couple of months, but then it jumped and started moving right back up. And so you can kind of see where our price appreciation has gone for the past 5 years. And that's why if you bought a house 5-6 years ago, you've got a lot of equity built up in your property right now. Now, overall for the Atlanta market, our median list price is right at $390,000. Year over year, that's up 16%. So we are at a 16% price appreciation for the year. Our active listings, whereas nationally active listings are down 50%, here in the Atlanta market, we're down 61%. So if you're wondering why we're seeing that appreciation, we have 61% active listings than we did a year ago.
Right.
New listing counts are down 5.1%. Our median days on market is 33, and that's down 23 from a year ago. And so that's going to continue to kind of drive kind of what we're seeing over the course of the rest of the summer here. We are expecting interest rates to start rising here, even slightly, and we think that will, slightly rising interest rates along with our historical normal trends moving into fall, we think we'll start to flatten the market a little bit more, and to where our numbers of buyers and sellers are closer than they are right now. We don't see anything like a bubble or anything like that coming, but we just want to keep you guys in the know here. Want to talk about lumber. So we're going to kind of wrap up running through lumber and lumber prices kind of thing. And so this is one of the most heavily utilized raw materials out there. Over the past year, the price of lumber in the U.S. has shot up by 377%, the fastest rise since post-World War II housing boom kind of thing. Wood that normally sells for $200 to $300 per thousand linear feet is hit $1,700. So what used to be $250, $300 for 1,000 feet is now $1,700. And so that is really driving a lot of pricing that we're seeing. That jump adds $36,000 to the average price of a new single family home. So those of us in the rental world don't think that you are free of this, because that also tacks on an additional $13,000 to the market value of multifamily, which is apartments kind of thing. And basically that's translating to an average rental increase of $119,000. For those folks who are in like, well, I rent, I don't have to worry about lumber prices. Guess again, right now these lumber prices are going to be affecting the rental market. So even though there's folks who are like, I don't want to try and buy in this crazy market, don't think that the rental market is insulated at all. The rental market, as property values increase, that is going to cause price increases in rentals.
Not only that, maintenance as well. Now, with this said, just want you to know what some of the new construction is doing, okay? Some new construction are not even putting their house on the market until it's fully framed and sheetrock before they will actually put the property on the market. There's two reasons for that. I have an agent that came to me a week prior closing, said this, the builder want to raise the price by 10 grand, $20,000, $30,000. It's like, that's not fair. The house is already built, the material's already been spent. And I look at the agent and say, have you thought about what it's going to do for the appraisal value of the neighborhood if they let it go at that price point? Because honestly, future builds are $40,000 more. So how can they justify not increasing that amount every time they sell a house in order to justify for future build? Because otherwise they can't build They're not there to lose money. So that's the flip side of the coin, even though the material has already been accounted for and what have you. But I can tell you that they're taking it at the other end of the spectrum too. And also just be aware, agents, right now we have seen some listing that has zero co-op commission. So if you used to write a contract with zero commission from the buyer, you're going to end up doing some of the services for free because the co-op is not offering any commission. So read your MLS carefully and make sure you know what you're doing.
Yep. All right. That's really good tips. So I'm sorry, I'm just going to jump us
It's
back
okay.
in. So lumber, and so when we start talking about why is lumber this way? Well, first of all, ever since the recession, we have not really been keeping up. So this is lumber demand in the U.S. and how it's really been kind of going up over the past 10 years. At the same time, our housing permits have shot up. So we went, housing units went from 1 million to 1.8 million, and total new construction projects in the U.S. is going to be around 1.5 million. And unfortunately, we can only build about 1.5 million homes a year. Still, that's a 67% increase over the last year. And so when you pair that with what's happened with remodeling, improvement, and repairs, with as many folks during the COVID times and the stimulus money, guess what they're spending their money on? Home improvement projects. And so when you see that from Q4 of last year to Q1 of this year, we're up nearly double, $353 billion more that we're spending at Home Depot and Lowe's and that kind of stuff. And so it really is impacting our lumber prices. And it's, unfortunately, they can't build the mills fast enough. And the mills can't really increase productivity. They're having the same hiring issues that a lot of people are, kind of thing. So, we are seeing a lot of those same kind of issues, or they are seeing a lot of those same kind of issues, and it's not going away anytime soon. So we are starting to see some softening on lumber prices. Thank you. But we still are, we're not out of the woods yet. Normally this thing takes between 9 and 40 months to flatten out. In the past, if you look at historical trends, unfortunately, we're at month 12. So, we'll see where this really works. We're going to wrap up with paint.
We do have shortage because all of y'all like to go paint, change your ring colors. Guess what? We're now in shortage of paint.
Well, it's one of those things, as weird as it sounds, the ice storms in Texas actually caused a lot of the problems because apparently in paint, there is a lot of byproducts from the manufacturing process used in making paint. But because of the ice storms in Texas, where all the refineries are, that's also the place that produces all these, and so they have not picked up their production since then. They're still, and that's what's really causing the paint shortage, I guess, is the big thing. So again, plan ahead, just like on windows, doors. We're seeing windows 4 months out to get windows, doors 4 months out. Now we're seeing paint, and we're seeing shortages of paint and basically different paint colors. We're not seeing the challenge is getting
not bad.
Yeah, you can get white paint, but a lot of times having some of those other paint colors are harder to find right now. All right, and that's pretty much what we have this week. So I hope this was useful for you. I hope that you guys got a lot out of it. And if we can be of any kind of service, please let us know. Have a great week. So call, text, smoke signals. We answer it all.
Because your tagline.
I did. That's my little tagline. So hope you guys have a wonderful week. Thanks, guys.
Thank you.
And Beth, thank you for being on.